Ladies and gentlemen, good morning and welcome to KEC International Limited Q3 FY23 Results Conference Call. We have with us today from the management, Mr. Vimal Kejriwal, Managing Director and Chief Executive Officer, and Mr. Rajiv Agarwal, Chief Financial Officer. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vimal Kejriwal, Managing Director and Chief Executive Officer. Thank you. And over to you, Mr. Kejriwal.
Okay, Mr. Good morning. I welcome you all to the Q3 earnings call of KEC. Let me start with an update on the overall performance for the quarter and thereafter talk about each of the respective businesses and the key strategic initiatives. We have achieved revenues of 4,375 crores for the quarter, a robust growth of 31% vis-a-vis Q3 last year. We are witnessing strong execution momentum across most of our businesses. The growth is backed by good performance in the T&D, civil and oil and gas businesses. With this, our YTD 9-month revenue stand at rupees 11,757 crores, a healthy growth of 24% vis-a-vis 9 months last year. We continue to deploy several mechanization, automation and digitalization initiatives across projects and engineering, which has significantly helped us to improve productivity and quality of execution. We have delivered EBITDA margins of 4.6% for the quarter, a sequential improvement of 20 basis points vis-a-vis Q2 FY23. The margins have been impacted primarily due to the execution of legacy projects with adverse commodity prices and the performance of the EPC projects in SA Brazil. I am pleased to share that we have completed the last EPC project in SA Brazil in December 22. During the quarter, we have secured significant orders of approximately 1,000 crores in SAE across Brazil, Mexico and US, including one of the largest power supply orders from a reputed developer in Brazil. With this, our order book in L1 in SAE has increased significantly to over rupees 2,000 crores, comprising of orders for supply of towers, hardware and poles. The robust order book reaffirms our confidence of a revival in the performance of SAE from 4 onwards. We delivered a PBT margin of 0.3% and a PAT margin of 0.4% for the quarter. We continue to witness a strong traction in the order intake. With the orders announced yesterday of rupees 1,131 crores, our YTD order intake now stands at rupees 15,554 crores with a growth of 10%. The order intake has been largely contributed by our T&D, civil and railway businesses, followed by cables and oil and gas. Most of these orders have been secured at current commodity costs. This gives us the confidence on the margin trajectory going ahead as these orders get into execution. The traction in order intake has enhanced our order book to rupees 28,981 crores, including the orders secured in Q4 till date, a robust growth of 19% vis-a-vis last year. Additionally, we have an L1 position of over 6,000 crores diversified across businesses. With this, our order book plus L1 position stands at an all-time high of over 35,000 crores, which is largely divided equally between T&D and non-T&D businesses. In a recent development, the Union Cabinet has approved the National Green Hydrogen Mission. This mission will result in development of green hydrogen production capacity of at least 5 million metric tons per annum with an associated renewable energy capacity addition of about 125 gigawatts in the country by 2030. The targets by 2030 are likely to bring in over 8 lakh crores investments and a significant increase in projects for solar as well as associated transmission lines and substations. Accordingly, we have restarted and refocused on the solar business and have secured our largest order to build a 500 megawatt solar PV power plant in India. This prestigious project will be executed over a period of 16 months. Focus on cash flows and working capital stands unabated. With dedicated efforts, we have brought down our working capital to 139 days as on 31st December 22, a reduction of 9 days against 30th September. Our debt level, including acceptances, continues to show a sequential improvement and has reached 5,617 crores as on 31st December, a reduction of more than 300 crores against 30th September 22. This is despite a sequential increase in revenue of over rupees 300 crores. We have reduced our debt level, including acceptances consecutively for the last 2 quarters. The total reduction is over rupees 450 crores against 30th June 22. We are confident of a further improvement in the working capital in Q4. Our interest cost stands at 3.4% for the quarter as a percentage of sales. The interest cost is higher owing to the steep increase in interest rates both in SA Brazil as well as in India and the elevated debt levels. Now coming to the specific businesses, our core T&D business has delivered stellar growth of 40% for the quarter vis-a-vis Q3 last year. The growth has been delivered on the back of robust execution across both domestic and international markets. The T&D business has significantly expanded its order book with strong order inflows of over rupees 7,000 crores across India, Middle East, Africa and Americas. In India, the business has secured its maiden order in the strategic segment of HVDC terminal station from a leading private player. KEC is the first EPC company in India to secure an order of this scale in this segment. The business has also diversified its customer base to include non-utility clients with 2 orders for GIS substation projects from a reputed power generating company and a leading refinery PSU in India. In international T&D, we continue to expand our presence with multiple order wins in key markets. We have also consolidated our leadership position in the Middle East market by re-entering Kuwait and securing large interconnection orders in the Gulf. The overall tender pipeline in T&D continues to remain strong both in domestic and international markets given the push for renewables and requirements for new transmission lines, substations and underground cabling. The outlook in Middle East remains positive, especially in Saudi and Abu Dhabi. Coming to railways, this business has achieved a revenue of 897 crores for the quarter. I am pleased to share that the business has secured YTD order inflows of rupees 2,900 crores, a healthy growth of 1.8 times vis-a-vis last year. These include orders in conventional OHE and composite projects, as well as orders in new areas of speed upgradation, technologically enabled areas of metros, and emerging areas of PCAS, train collision avoidance system under Kavach, which aims to enhance safety of Indian railways with world-class technology. We are witnessing an increase in competition, especially in the conventional segment with the entry of road EPC players and Tier 2, Tier 3 EPC contractors. Our civil business has delivered another quarter of strong performance with revenues of rupees 845 crores, an impressive growth of 75% over Q3 last year. The growth has been delivered on the back of robust execution in water pipelines, metro, industrial and residential projects. The civil business continues to deliver consistently on the order intake front and has secured YTD orders of over rupees 4,800 crores. During the quarter, the business strengthened its presence with significant order wins in the water pipeline, industrial and data center segments. We are pleased that our foray in the data centers is reaping results, and we are now executing 4 data center projects across India. The uptick in order intake has significantly enhanced the order book plus L1 to approximately 11,000 crores, comprising of turnkey EPC projects across segments from marquee clients. The business outlook continues to remain healthy, largely driven by improvement in private consumption and government capex. We are confident that this business will continue to be the key growth driver for us going forward. In oil and gas pipelines, the business has delivered revenues of 159 crores for the quarter with a growth of over 2 times vis-a-vis Q3 last year. The business has a strong order book plus L1 of over 900 crores, comprising of government and private players. We are confident of scaling up this business both in India as well as in the overseas market. Our cable business achieved revenues of 368 crores for the quarter. The business continues to deliver well on the order booking front with good traction from domestic as well as export markets. The business is also progressing well with the development of 10 new products this year, of which 4 products have been commercialized already. We are in the process of further enhancing the backward integration and augmenting the production capacity of LT and telecom cables by adding a few balancing equipments. In ESG, we continue to take several measures to transform our operations in a sustainable manner. Installation of solar energy capacity at our manufacturing plants is one of the key strategic actions to increase renewable energy usage through in-house generation and reduce greenhouse gas emissions. During the quarter, we have installed solar rooftop at our Dubai plant in addition to the existing rooftops at our Nagpur and Jaipur plants. With this, 20% of our total power requirements will be catered through solar energy. I am glad to share that KEC has been recognized as one of the best construction companies of the year at the reputed Construction Times Award 2023 for our best-in-class project management practices, new age engineering solutions, and strong focus on quality and safety. Moreover, we have also won the Best Metro Rail Project for Safety and Innovation for our Kochi Metro project and the Best Railway Project of the Year award for the Hubli-Tinaigat Railway Electrification Project. Overall, I understand that some concerns have been expressed on our margins and interest costs for the quarter. However, I would like to highlight that we have delivered on the following fronts as mentioned earlier. We had increased our revenue guidance for the full year from 15% to 20% last time. The growth of 31% year-on-year in Q3, we are confident of exceeding the targets of 20% growth. In SAE, we have closed our last PPC project this quarter and are confident of a revival in the performance from Q4 onwards. We had conveyed that our margins will start showing a sequential improvement from Q3 onwards, and we have delivered an increase of 20 basis points. We have brought down our net debt, including acceptances, by more than 450 crores in the last 2 quarters, against our guidance for 500 crores for the full year. This is despite a 9-month revenue growth of 24% Y-on-Y, and we are very confident that we will be able to achieve our 500 crore target for debt reduction. With the traction in orders, we have built our highest ever order book plus L1 of over 35,000 crores. The outlook remains robust across most of our businesses with a tender pipeline of over 1,11,000 crores. This gives us confidence in delivering a continued good growth in the quarters to come with an improvement in the margin trajectories going forward. Thank you very much. I am now open to questions.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may please press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may enter star 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Parikshit Kandpal from HDFC Securities. Please go ahead.
Hi, Vimal sir. Congratulations on a decent quarter and reduction in debt. So my first question is on the margin. So if you can highlight in this quarter, how much was the EBITDA contribution from SAE? That's my first question.
Parikshit, good morning. I think our SAE, we had a loss of around 50 crores. 50 crores on the EBITDA.
50 crores loss. But if I reconcile the Concall and the standard numbers, there's a 20 crores EBITDA positive EBITDA is there. So how did that happen?
So I think that's one of the reasons why there are some questions on the standalone margin. What is happening, Parikshit, is that we have got 3 or 4 other subsidiaries which are operating subsidiaries 100% owned by us. So we have a Dubai, we have a factory in Dubai, we have a Dubai LLC, we have a as per local laws for Malaysia also we need a subsidiary. So these subsidiaries in the last few quarters have started a lot of I say business and margins. So when you look at standalone versus Concall, it's not just SAE, it's also these 3 and also our oil and gas spur which we acquired is again 100% subsidiary. So all these 4 or 5 results are now getting coming through the Concall part of it, which is why you are not able to directly reconcile the numbers from what I told you.
Okay. My second question is on the standalone, sir. I mean, now SAE seems to be improving, and you said from fourth quarter it will come back, maybe break even. So, but on the standalone, we have reported almost all-time low margins of 4.7%. So it has been like last quarter it was 6.2, before that 8.2 and 7.3, and earlier it used to be 9 to 10. So why is a sharp reduction in the standalone margins? If you can highlight any pain points or segments or any one-off during this quarter that has led to such sharp dip in the margins. And whether going ahead, how do you look at the margin in the standalone segment in the coming quarters, like from fourth quarter?
Parikshit, there are two basic reasons for that. One is what I mentioned earlier, where quite a few of our new T&D orders, especially in Abu Dhabi and some of our tower supply orders, and also a largely profitable order in Malaysia are through the subsidiary. So some part of that has gone into the subsidiary. So that's one reason. Okay. Going forward, I think we're going to start looking at Concall probably more than this, because these, especially the Middle East subsidiaries, will continue to do a lot more business. The second part is, if you remember, we have been discussing about 5% of our order book is from legacy projects, and during the quarter we have had a fairly decent execution, I'll say, in some of the legacy projects, especially because the commodity prices were going down, and then there was some resolution of power grid on the TBCB projects which were under the GIB hold. So we did do a lot more revenues to close the older projects. So that's the reason why the numbers have come down, and the numbers are primarily on the T&D side, which are lower.
So how do we read the margins from the fourth quarter on the standalone business, the India piece, leaving aside the subsidiaries in the Middle East? So the embedded margins in the current order book. So if you can give some sense whether this is the bottom of the margins, and how do we see it for next few quarters for the India business?
So, Parikshit, I will respond on the Concall. I don't have the standalone numbers for Q4 and all that. But as we had said that the margins got, I'll say, bottomed out in Q2. Q3, we would have loved to see a higher margin, but, that's what we have been able to, deliver because of the commodity at 4.6. We are very clear that the margins will show an uptrend continue to show uptrend. I will not be able to give exact numbers, but I think at least 75 to 100 basis points improvement should happen in Q4. And then obviously further improvements will happen in FY24.
Okay. Thank you, sir. That's all my questions.
Thank you. The next question is from the line of Kunal Kudania from DSP Investment Managers. Please go ahead.
Hi, this is Vivek Ramakrishnan. I've got two questions. One is, sir, you had mentioned current prices of commodities, and if you see, even aluminum prices have gone up decently from the bottom, 2,250 to 2,600. So what is the comfort band that we can take in aluminum prices for your order book is the first question. I mean, I'm just using aluminum as a reference commodity. The second question is the order inflow in Q3. We thought it was lower than what we've seen in previous quarters. Are there some delayed orders which will come through in Q4 and hence boost up the order book? Those are my two questions, sir. Thank you.
I think on the second question, we are L1 in some large orders, and unfortunately they got delayed in the sense that we were expecting them by 31st, but they have got delayed. So maybe we should see the conversion happening very quickly. So there's no, I'll say, delay or anything that way. I think by Q4 end, we should be looking at the numbers we have been talking about, 18 to 20,000 crores of order intake. I think we are on line to achieve those numbers. Okay. Sorry, what was the first question?
Sir, the first question was on aluminum prices in terms of,
Okay. So, Kunal, largely we are hedged on all aluminum. When all the new orders, whenever we got them, we have already hedged all this. I think a very small portion on the legacy orders is still open because those projects are, in a way, still not fully cleared by the client. And we can't take supplies, etc. So a small portion of it is open, which I think hopefully if we get clearances should get closed either in Q4 or maybe in Q1. But the numbers are nothing to worry about.
Which is why you're saying that the margins will improve a little more in Q4 and then a lot more in Q1. That's why you're projecting that trajectory.
So hopefully by Q4, most of these things should get closed if we get our clearances or we will provide for it. And then it will go into, Q1 and all that. We should start with, I'll say, virtually a clean slate.
Okay, sir. Thank you very much and wish you good luck.
Thanks, Kunal.
Thank you. The next question is from the line of Renu Baid from IIFL Securities. Please go ahead.
Yeah, hi, good morning, sir.
Morning, Renu.
First question back on profitability. So if you look at the standalone business, reported EBITDA margins at 4.6 or approximately in EBITDA terms hardly 180 crores. And theoretically, if you assume that the non-T&D ex oil and gas, which is mostly India-centric, would have made average 8% EBITDA margin, then there's hardly 10-20 crores of EBITDA that has been contributed by the rest of the T&D business, domestic. So, what kind of losses are we seeing for certain large central sector projects, which were legacy projects? If you can help to provide some insight, if you give us inputs in terms of, when do we see these losses from these domestic T&D tapering out? And also sequentially, while you did mention there's a margin 20 basis point improvement, it is almost flattish. I'm not sure to what extent we should look at as a notable improvement. So, 4Q also you're guiding just 100 basis point margin expansion. So apart from SAE, which will break even from next quarter, some more inputs in terms of, the loss-making domestic projects and what kind of turnaround are we expecting and what is the value of these projects still remaining in the backlog, which will be executed in the next 2 quarters?
So Renu, first of all, I never said notable improvement in performance. What we had said is that from Q3 onwards, the tide will turn and we'll start seeing a change in the trajectory, and which is what I alluded when I said that it's gone up by 20 basis points. So as I said earlier, I think in our view the bottom has been touched and now we will see an improvement. So that's putting the words right. Okay, the second piece is that you're right more or less on saying that the T&D margins have been very poor for the quarter. Okay, and we were very clear that we had some orders, especially on the TBCB side. And also, if you remember the old SL order, which was taken over by Adani, so
right.
It was a fixed price order. So those 2 orders have been the primary contributors. And third, now that the logistic costs have come down, but because of the large increase, our international business is doing at least a 50% turnover higher than last year. We did incur a large logistic cost. Fortunately, the logistic costs have now come down to back to normal or even actually below normal, below some of our tender estimates now. So to me, the execution of TBCB projects, especially on the steel side, now almost, I'll say on the legacy side, our steel orders are virtually zero. We have almost executed everything on the steel side, maybe a couple of thousand tons here and there, which are not cleared by the client, is pending to be cleared. So which is why we are expecting Q4 to start, picking up. There are some small legacy orders which are there, which we want to, close. Which is why Q4 we have a sort of a guarded optimism.
Got it. So once done with Q4, T&D, which is the core business, almost 50% of revenues, do we see margins? When do we see the margins coming back to at least 9 to 10% level, which used to be the normalized or subnormalized margins for the segment? Should it happen in 24, late 24 or 25?
So Renu, to me it should be around Q2 or something of FY24, okay? Because I think the legacy order should get over in Q4. Maybe there may be a little bit spillover here or there, which is why I'm a little bit, guarded on Q1. But I think from Q2 onwards, we do see that the T&D margins should start getting back completely to our normal margins. Got it.
Sure. And on the SAE, now that the EPC project is done, we have a fair share of new tower supply orders with us. Is that business now looking back at mid-single digit kind of EBITDA margins? And do we expect any compensation from customers after project closure?
So those discussions are going on. I'm not very hopeful of getting too much money. Okay. So I don't see that much will come in or whatever. So those projects have been also almost commercially closed also. So that is why, Q3 we had slightly higher than what we would have loved to have as EBITDA losses. Coming back to a question on the SAE margins, our expectation is that Q4 we will definitely have an operating margin between SAE, Mexico and Brazil put together. Hopefully both of them should be positive. Otherwise, at least on a totality, we definitely see that the numbers should be clearly positive. I'm not sure whether PBT would be positive because our interest cost right now is high. We are working on the refinancing of of the Brazil loans, which I think is happening. I think a large part of it should get refinanced in this quarter, which will bring down the interest cost going forward. So I think from Q1 onwards, I will just start saying that will we become PBT positive in Q1? Maybe. But Q2 onwards, I think we should start seeing PBT positive in SAE also.
Sure. And lastly, on the debt numbers, what is the year-end net debt number finally expected, sub 3,000 crores, given that 500 crores of reduction that I've targeted? And on the cash flows, what are the progress on cash flows from Afghanistan and railway projects which were stuck for last 1 year? Have those projects started to move, and how do we look at the cash flows improving for the business?
I'll let Rajiv answer, but just on principles, I think railway projects have started moving in. Cash flow has started coming in, which is why you're seeing a reduction. Afghanistan, we have not got a single rupee or dollar till now, but we do expect, and we had earlier said that in Q4 we should be getting maybe 200, or I don't know the exact number, between, I think as a benchmark, maybe you can take a 200 crore figure, that we should get around 200 crores in this quarter. Maybe Rajiv, you want to answer on those?
So, Renu, basically on the debt side, I'm expecting probably further reduction of about 300 crore rupees in the Q4 also. Okay, so from the current level of 5,600, I expect the debt should go down to maybe 5,300 or maybe 5,200, something in that region. And that reduction will happen because we are expecting further, revenue growth of maybe 20-25% in Q4 also. So that reduction will take our NWC down to maybe about somewhere between 125 to 130 days. So that's a target range we are working on for debt reduction, and that will give us a substantial debt reduction, because for the full year the growth of the revenue itself will be about 20% plus. So with the 20% plus kind of a revenue growth, which will be absolute term, will be about 2.5, almost 3,000 crore. And with that, the debt reduction of almost 300 crore is what we are targeting for the full year as a whole.
So, let me just put in a different fashion. To me, we had thought we'll go to 5,000 or something as this, but because the revenue growth is slightly more than what we had projected, that may have an impact of 100-200 crores in terms of the absolute debt. But the NWC, which has come down, will come down further. So there is an efficiency effort on collecting more.
Right. And what is the average cost of capital for us to domestic debt?
So right now, Renu, it is between, let's say, 7 to 8%. Some of the debt from the banking side is coming at about 7%, 7.5%, and CP market is also moving in a similar fashion.
Thank you, and all the best, sir.
Thanks, Renu.
Thank you. The next question is from the line of Saket Kapoor from Kapoor and Company. Please go ahead.
Yeah, namaskar, sir, and thank you, Renu ma'am, for covering. Yes, thank you, Renu ma'am, for covering most of the points. Sir, if CFO sir, if you could give us the breakup, how has the forex played in terms of the finance cost for this quarter as well as for the 9 months, the forex impact?
So, Saket, I don't have exact. I think around 30 crores or so has been the overall number for 9 months. 30 crores positive.
30 crores positive. Okay. So the 9 month finance cost is 377. This has an inbuilt profit of 30 crores.
No. It doesn't go in the finance cost. Finance cost में तो जो ब्याज लगता है ब्याज जाता है उसके अंदर. This is on the top line and bottom, because जहाँ पे जो पैसा आता है हमारा वो अलग रेट पे आता है, hedge किया हुआ होता है, तो सारा मिलो के है ना. It goes into other income basically.
No, other expenditure. So Saket, this is part of other expenditure. It is grouped foreign exchange gain or loss, and this is a gain of 30 crore rupees. This is actually getting clubbed in the other expenditure schedule.
Okay, sir. Sir, we also acquired one company which was in the laying of pipes. What is the update on the same? How is the order booking and what has been the performance?
I think आपने late join किया होगा. मैंने कहा था कि quarter में we had a revenue of around 159 crores और order book plus L1 करीब उसका 900 करोड़ है. और रेवेन्यू उसके अगर आप देखें पिछले साल से करीब 75% 80% ज़्यादा है.
राइट सर. एंड सर केबल सेगमेंट में देख रहे हैं कि ईयर ऑन ईयर में डिप है रेवेन्यू में. आप जैसे प्रोडक्ट इंट्रोडक्शन की बात कर रहे हैं, तो अभी ये कैसा देख रहे हो सर? EHV में कैसा ट्रैक्शन है पर्टिकुलरली? अगर केबल बिजनेस का आउटलुक कैसा देख रहे हैं, EHV का ट्रैक्शन कैसा देख रहे हैं?
Marginal dip है इस साल में. What has happened is that with the volatility in the commodity prices, copper and aluminum, and since copper went very high, we did see some of the buyers staying out. We will wait for some more time till copper stabilizes. So थोड़ा सा डिमांड में we are seeing a volatility because of the metal prices. बेसिक डिमांड में कोई इशू नहीं है. EHV थोड़ा सा कम बिका है इसको अब लास्ट 2-3 क्वार्टर में, बट अब काफी डिमांड है. सो आगे से EHV अच्छे से चलेगा.
अच्छा सर, मैंने टोटल रेवेन्यू का पाई क्या होगा EHV का सर?
EHV नॉर्मली हमारा होता है करीब 30% के 20-25% होता है. 25% मान लीजिए आप.
और ऑर्डर बुकिंग का सेम ट्रेंड होगा? सेम ही ट्रेंड रहेगा सर. SAE पर सर एक क्वेश्चन था कि सर अभी SAE ने टोटल 9 मंथ्स में कितना ब्लीड किया हुआ है, और सर इसको फंड कैसे कर रहे हैं हम?
फंड तो लोन से ही होगा, मतलब चाहे वहाँ पे लोन ले, चाहे यहाँ से लेके इक्विटी भेजे, अल्टीमेटली तो डेट फंडिंग में ही जाएगा, चाहे उनके बुक्स में रहे या पेरेंट की बुक में रहेगा. लॉस तो अभी तो उसी से फंड होगा, क्योंकि वहाँ तो सब्सिडरी है, तो इक्विटी जो होती है वो इक्विटी हमारे यहाँ से जाती है ना. तो अब तो उसमें इक्विटी की जरूरत है नहीं, बिकॉज अब तो उसकी लॉस बंद हो गए हैं
जी. और टोटल 9
में आना पड़ेगा. बहुत लंबी लाइन है.
हाँ सर, 9 मंथ का बस आप मुझे ब्लीड नंबर बता दीजिए, कितना घाटा लगा है.
मैं अभिषेक को बोल दूंगा, बाद में बता देगा आपको, है ना.
ठीक है साहब. ऑल द बेस्ट सर. थैंक यू.
Thank you. The next question is from the line of Priyankar Biswas from Nomura Financial Advisory. Please go ahead.
Good morning, sir. My first question to you is, like you have spoken about this, probably the margins, how it would go on a trajectory. So what I am trying to understand is, like if you have to guess, what can be broadly be the 1H FY24 margin in your view? And also parallelly with that, what is the current non-T&D EBITDA margin?
Very difficult to give you 1H numbers right now, okay? But as I said that we do expect around 75 to 100 basis point increase in Q4 and Q1. To me it's difficult right now, but maybe I don't know whether we can take a similar increase or something. That's what we should be looking at. 1H Q2 is right now difficult to see, but as I was telling Renu earlier that Q2 onwards we should start getting T&D margins back to normal. We'll wait and watch, but I do expect that quarter on quarter there will be an improvement till probably Q3 or so where we reach that margin. So to me you have March, then you have Q3, Q4, then you have Q1, Q2. I think each one of them you will definitely see an improvement happening in the margin, quarter on quarter sequentially.
So if I extrapolate that, so maybe would it be fair to say that at least by 3Q FY23 or 4Q FY23, something around that, you should be broadly at around 9 to 10% exit rate? Would that be a fair assessment?
Q4 exit, I think we should be on target, what you're saying.
I said just asking a broader question, can you help us with the share of private orders in your book at the present, and what are the key corporates that we have exposure to?
मेरे पास अभी डायरेक्टली नहीं होगा but our private orders are where? Our private orders would be in SAE mainly. In India में we will have, in civil we will have private orders, okay. In T&D अभी थोड़े बहुत हमने लिए हैं लेकिन बहुत ज़्यादा नहीं है. So I don't think in T&D we have any major piece of private orders. It would mainly be in civil, and we'll have one or two small orders in railways. Not big orders, but on the port side and all that, port connectivity, etc. We have got one or two smaller orders. So it will not be very high in terms of I'll say non-civil. Okay, civil maybe it's basically more on the residential and industrial.
So sir, just continuing, just on the working capital side of things. So I remember that there were some large retention money with railways based on the last couple of calls. So what is the status of that? And do we see that leading to some sort of a working capital improvement, let's say next quarter or the quarter after that?
So Priyanka, it was not actually retention. What has happened? It was not actually retention money. What happens in railways is that with the new concept of EPC projects, they are more milestone-based payments. So in some cases, since milestones had not been achieved as per the contract, the payments have been held back, and those payments are coming. So when Rajiv talked about an improvement in the numbers for working capital, a part of that was on the back of expecting that we will get our railway money. It's normalizing. If you want, if it's a direct question, if you're asking, yeah, it's normalizing. So I think by end of Q4, we should expect that the railway receivables will be normalized.
Thank you, sir. And just the last question, if I may squeeze in. Like last quarter, I think 5% of the order book was roughly legacy, is what you had highlighted. So what would be the similar number now, like from 5%, what it is down to probably?
I don't have the exact number, but 1% to come ho gaya, because we have done a lot of execution out of that. So maybe 3 to 4%.
Okay. Thank you, sir.
Thank you.
Thank you. The next question is from the line of Amish Chunilal Kanani, from GM Financial PMS. Please go ahead.
Yeah. Hi, sir. Sir, congrats on a good execution, though it's coming at a low profits. Sir, two questions. One, sir, L1 is now a little bit higher, in our order book. So if you can give us some flavor of, is it one order which is chunky? Is it government, private, and are we looking at closing it soon? Or is it the nature of the beast that we have one L1 converts into order book and then the L1 comes into the picture? Some flavor there. And overall 1.1 lakh crore of pipeline. Any indication of what could be the win rate and any early indication of what could be the order book accretion for next year over this year's base of say 18-20,000 crores, sir?
So Amish, most of the L1s are from government. Okay. And there are one or two large orders in that. We do expect that they will get converted into orders in maybe a week or 2 weeks or 3 weeks. So I think within February, we do expect that a large chunk of this L1 will get converted into orders. So that's one part. As far as order intake is concerned, as I said that we are expecting, we are already at 15,000 plus, and I think with these tenders getting converted into orders, we should be around 19,000 or so. Assuming that there will be a revenue growth of 15% next year, we do expect that our order intake target next year should be at least 22 or 23,000. We are not yet frozen on numbers. I think the budget making exercise is going on, but it will definitely be 20 plus. I don't know exactly what numbers will come out from various businesses, but I think 22,000 to hoga mere hisab se.
Okay, sir. Yeah. So the question was, are we having the profitable orders which, we want to win, or, maybe we'll kind of contain ourselves and, focus on maybe lower orders, but very profitable orders. That was the context in which I was saying. Sure, the numbers will evolve and maybe.
Amish, you are very right, which is why, I said that once we start receiving numbers from businesses, we'll decide ki, kya karna hai, nahi karna hai. But I think to us, very clearly, the focus is not on revenue growth. Okay, if that's your question, that's my answer. It's not on revenue growth. We will look at continuing to see how do we improve the profit margins on the orders. We will definitely not take orders where the margins are lower. I think we are very clear in our thought process on that.
Sure, sir. And so second, if I annualize the current quarter's interest cost of 150 crores and average the last quarter's debt, including acceptance, and this quarter, our interest cost goes to more like nearer 11%, 11.75 or 10.75 or something like that. And you did mention our domestic interest cost is 7 to 8%. So if you can give us some flavor of whether the rest of the cost is all Brazil or domestic versus non-domestic interest cost, and are we looking at significant lowering of interest costs on a blended basis? So say 11 and particularly in the context of rising interest costs, sir. Thanks.
So, Amish, I think what is there in the interest cost is also interest on customer advances, because there are a lot of customers which are, as per the CBC guidelines, they are now, all the government companies are being mandating to charge interest on advances. So that's one element which is there. The second is the element on acceptances which is there, where there are interest costs. So to me, if you look at our inventory, what is going to happen is that our interest as a percentage of revenue will definitely go down in Q4. One is because the revenue is going to be very high. And I think let's see what happens. There's an FOMC meeting today also, and then the RBI meeting. What happens on the interest cost, that will decide. Third piece is that with the dollar strengthening, the premium rates have been going down. So a little mix of our borrowing with more forex borrowing, which has at least 200, 300 basis points advantage. So somewhere we do expect that our interest cost as a percentage of revenue will come down. And I think overall also in terms of the interest rates, today when we're talking about 7.5, 8 and all that, the average interest rate may all down slightly. I don't see it going down significantly because the market may still go up, but we may be able to optimize it slightly.
Oh, sure, sir. Sir, if you permit one last question on the green corridor, sir. A lot of expectations. So if you can give us some flavor of how big is the opportunity. Maybe today's budget also will outline some more details there. But how big is the opportunity, and are we looking at growth even from there?
So there are two green corridors. I think there are a lot of tenders which are even open today, and some of them are getting quoted, I think, this week or next. Okay. So there are quite a few tenders which are out open right now in Gujarat, a little bit in Karnataka and Rajasthan. So clearly this year we will see a lot of N&D awards happening on the back of the green corridor. That's the current green corridor. The second piece is what I had talked about, green hydrogen and all that. So projects are coming up in Gujarat and Rajasthan again for green hydrogen, which renewables have been set up. Okay, with the renewable which we announced, 500 megawatt is coming up in Karnataka. So all those are for that there will be further lines which will come up. I think those lines we have not yet seen coming up, except for some lines in Gujarat, Khavda region. We are seeing some tenders which have come up. Others will now come up. So I do expect that probably in H2 there will be a lot of tenders which will come on the back of renewables for green hydrogen.
Sure, sir. Thanks a lot.
Thanks, Amit.
Thank you. The next question is from the line of Tina Virmani from Kotak Securities. Please go ahead.
Hi, sir. Part of my question is already answered, but one thing on the interest side, you mentioned that on the domestic, the average interest rate is around 7 to 8%. Can you specify how much is the debt at SAE level and what are the interest rates over there, and what kind of refinancing reduction benefits from the refinancing that you are expecting on the SAE side?
So, Tina, thanks for being there. I think our overall debt in SAE is around $50 million. Okay, and we are looking at refinancing a large part of it. And hopefully now that the EPC is behind us and the business starts turning profitable, we will also start getting better rates apart from the refinancing also. In refinancing, we are expecting probably a reduction of 4 to 5%. That's what's going to happen on the thing.
Okay, and what would be the current interest rate? They are in the range of 18-19% or?
Between 18 to 20%.
Okay, so it will come down to around 14 to 15%.
Yeah, I think that's 12-13% is what we are looking at.
Okay. And my second question is related to the legacy projects. You talked about that only 3 to 4% of the order book is around legacy projects on the T&D side. So why are we so conservative in terms of margins for even 1H of FY24? I mean, technically, it's just 3 to 4% of the entire order book. So, and they are all legacy projects. So why can't we just complete it and get over with it and start focusing on the newer orders which are at relatively higher margins? So, I mean, my question is more related to the margin improvement trajectory that ideally should come up for KEC for FY24, even from 1Q or 2Q onwards.
I think, Tina, we are trying to do exactly what you're saying. We're trying to push the execution of newer projects and close the older projects. But at least 2 or 3 of these older projects are stuck up in the GIB issue in Rajasthan, and They are getting cleared one by one by the court and Power Grid. In fact, this quarter we should finish at least two of those projects in Rajasthan, green belt. So I think we are trying our level best to finish. And I think the other issue is that all these delays and all are causing further escalations, and we are negotiating with the client and all that to get the escalations, because the majority of the delay is not because of our side. So that's just going on. So I think we have to, the other piece which is there, Tina, is that today there is a lot of volatility. Even one of the earlier speakers also talked about saying aluminum has gone back to 26. So I think somewhere we are also hedging our bets to ensure that, we deliver on what we commit. Otherwise, we talk about today something and, the numbers change differently. It becomes a problem. I would rather err on the side of conservatism rather than, being aggressive.
Mm-hmm. So if we take off these projects which are stuck up because of GIB issue or even any further escalation also, apart from these orders, from the existing order book, what could be the margin trajectory in a current scenario when commodity prices are relatively lower when you would have bid for those projects?
So typically, our margins on order would vary from 8% to 12, 15, or maybe upper they could be higher also. But generally, margins would be around 8 to 10%. Generally.
For the remaining order book, X of these.
For all of our orders which we are quoting, generally we quote on that sort of margin. So more or less you can assume that way. Okay.
Got it, sir. Thank you. Thank you so much.
Thank you. Thank you.
Thank you. The next question is from the line of Uttam Kumar Shrimal from Axis Securities Limited. Please go ahead.
Yeah. Thank you, sir, and thanks for the opportunity. Sir, what kind of capex we are envisaging in FY24 and FY25?
Our normal capex has been around 200 crores. Okay. Next year, maybe I think we are looking at around 250 crores. But I don't see it going up because, for civil, since we are relatively new, we have been spending a lot of money on civil. And I think for the last 2-3 years, whatever we have spent and what we plan to spend next year should build up an added buffer for us. So average up 200-250 crore, you can go ahead.
Okay. And sir, this quarter our interest cost has been around 150 crores. So can we expect same run rate in quarter 4, or we are expecting some lesser amount of interest in the quarter 4? Hello.
So I think we are expecting somewhere around maybe a 10% reduction. So we should be around 130-135 crores is what we are expecting.
Okay, sir. That's all from my side, and all the best to you.
Thanks, Uttam. Thank you.
Thank you. The next question is from the line of Ashish Shah from Centrum Broking Limited. Please go ahead.
Yeah, thank you for the opportunity. Sir, firstly on the segmental margins, would it be safe to say that civil and railways would have been somewhere around 9 to 10% for this quarter?
I don't have the exact number, but it would be slightly lower than that. Okay, but it's not very.
I'm sorry, sir, we are not able to hear you. Can you please repeat, sir?
You're not able to hear me or Ashish?
Sir, we couldn't hear you. May I request you to please repeat?
Okay. So I said that I don't have the exact segmental breakup and all that, but I think we are closer to your numbers, not exactly. I think maybe slightly lower than that number, Ashish.
Got that, sir. So second is on the solar business. We did say that we are thinking of, we have actually re-entered the business. But this historically has been a low margin business and has had several issues in terms of government regulatory flip-flops. So where do you see the clarity now that you want to sort of build up this business again, and what kind of margins you will expect in these orders?
So Ashish, most of the flip-flop have been at 2 different levels. One is on the custom duty on modules. Sometimes you have safeguard, sometimes you don't have safeguard, and other things, and whether you can import from China or not import from China. That's to me the basic thing. And second thing has been on the receivables, from the discoms and all, whether they get it or not. So I think for us, what we have done is that we have very clearly said that we will not take projects where the modules is in our scope, or we tie up with a where there's a domestic module requirement, then you tie up with a domestic module manufacturer who becomes your partner in the bid. So for us, I think we have learned our lessons. We have seen what others have done. So I think we are playing it safe and looking at it as a pure EPC minus modules. That's the way we are looking at it.
So you're saying our scope will not include modules even in the projects that we are bidding. We will partner with the module manufacturer.
So current project which we've got around 700 odd crores also is without modules. Going ahead also, what we have said is that we will not take projects where modules are in our scope or where modules are on a fixed price. Okay. There may be projects where you have got local partners who manufacture, and if they want to join you as a partner and they take the responsibility, we may look at it. But right now, all our bids what we are looking at are without modules.
Right. And would you look at somewhere in like high single-digit margins for this business?
Definitely, no question of looking at less than that. Okay.
Right. So one question on the balance sheet side. So we had been expecting some unwinding of GST receivable. I mean GST, those credits that we have in the balance sheet. So probably around 500 crore is what we had been expecting. Can we indicate what is the progress of that this year so far?
So basically, on Ashish, on the unwinding of GST has started. Okay, yeah. In one of the business in railways, the unwinding has happened to the extent of about 100 odd crore in the last quarter. Okay. But overall unwinding is really visible as of now because there are some additional stocks that we have purchased because of the very volatile raw material prices, and also there is some unbilled which has actually increased during this period, which will get billed to the customer in the quarter 4. So definitely, unwinding on the GST account has happened, but 500 crore was a total amount, and what I remember is that I guided that to the investor, this 500 crore unwinding will 2 years time. Okay. So we are on track on that side. So I think in Q4 also I'm expecting another 150 crore unwinding should happen on the GST fund.
Right. So lastly, any word on, I mean, you did say that you've not got anything from Afghanistan, but any word on where we are in terms of our negotiation and when do you think the money can come?
So Ashish, what I had said was that we expect to get around 200 crores this quarter.
Okay, sure. Fine. Thank you.
Thanks, Ashish. Thank you.
Thank you. The next question is from the line of Peter from KEC Wealth Management. Please go ahead.
Hello, sir. Sir, I was just wondering on the railway and Middle East projects, what are the major projects you're executing and what would be the margin profile for the same?
We are executing a lot of projects. So if you want more details, maybe we can speak to Abhishek who can give you, more details on exact type of projects and all that. But railways, we are doing all sorts of projects, whether it's your laying of tracks, even on the metro side, ballastless tracks, signaling. So virtually, we have a project portfolio has got almost everything. And if you look at the Middle East, is what you asked, so Middle East, transmission lines, we have got substations, we have got underground cabling. Yeah.
Okay. And what is the margin profile on those, sir?
Difficult to give an answer like that because margin profiles are vary from project to project. So typically most of our margins when we quote around 8 to 10, but individual projects will definitely vary.
And second, last question that I wanted to know is that little technical. With a major shift happening towards renewables, is there any medium to mild impact on the T&D business going forward?
To me, it is actually, in a way, I look at it more positively because if you look at most of the projects which we have secured in India and elsewhere are for the transmission of power generated by renewables. Okay. So what happens is that renewables will, especially solar and all, will come only in specific parts of the country, but the power is all over the country. So we are actually seeing large transmission lines getting built and talking. Leh Ladakh has been talked about for a long time. Where we are talking about a huge project. So to me, renewables has not been a area of concern. In fact, we look at it very positively.
Okay, thank you, sir. That is all from me.
Thank you. The next question is from the line of Amit Anwani from Prabhudas Lilladher. Please go ahead.
Hi, sir. Thanks for taking the question. So my question is with respect to railways business, as we have been highlighting from past few quarters about the retention and milestone and increasing working capital. So the current order and mix which we are getting into railways, so what is your outlook about the working capital, and is this milestone and retention is changing in favorable with respect to the new orders you are receiving?
So Amit, what has happened is that after the first few orders came in, and then everyone realized that there are problems in the way those milestones have been fixed. Railways have also changed many of their payment criteria. I'll give a simple example. Earlier, let's say if you're supplying an equipment, that equipment would not be paid unless a particular segment of the line was commissioned. But now they have said that, okay, once you supply an equipment, we'll pay 80%, 90% of the equipment. So to me, although the milestone payments remain, but there have been significant changes on the payment, especially on account of what they call on-account payment. So you do your supply, you get your payments and all that. So that is one part. Second part is a section of our order book is now moving towards metro, where we are doing ballastless tracks, signaling, power supply, etc., which are shorter duration projects. I'll say better payment terms. So I think railways, as I said earlier, the working capital should get normalized by the end of this year.
Okay, so this shorter duration and better payments would be contributing how much to the order book in railways?
I don't have the number right now. Okay. Yeah.
So with respect to civils business, you already, I think, mentioned about margin somewhere maybe 8 to 9%. Just wanted to understand which are the major sub-segments expected to contribute in civil. I think you highlighted about data centers. We are executing 4 projects in few other sub-segments. So just wanted to have an outlook on civils.
There are, I would say 4 or 5 segments which are there. One is obviously the water pipeline segment, where we have got large orders where you supply potable water to villages. So that's right now our largest segment. Second one would be metro viaducts. So we are right now to 7 projects on metro. So that's the second one. Then we have residential projects. I think we will get probably revenue almost close to 1,000 crores or slightly less than that in residential. Then you have industrial projects. And then you have what we call, public spaces. So we are building an airport, we are building a high court, we are building some MLA and all that. So I'll say broadly, this is the way our segments are divided. And I think last one is we've been bidding for international. I don't have an order right now, but hopefully from next year onwards, we'll also see some international revenue flowing into civil.
Right, sir. So my last question is, I might have missed out on the order prospect for international T&D, domestic T&Ds, and railways and civil for FY23.
Sorry, what do you want? Sorry, I missed your question. What do you want?
Sir, just wanted to understand the order prospect in international T&D, domestic T&D, railways, civil.
What we have said, Amit, is that we expect our revenues to grow by around 15% next year, and so order intake should also be growing by that sort of percentage. So if we expect around 18,000-20,000 of overall order intake this year, maybe 20,000 plus 20,000 would be the target overall for order intake. Which business, what we take is something which we are still working out exactly.
Okay, sir. Thank you.
Thank you, Amit.
Thank you. The next question is from the line of Kaushal Dedia from Axis Bank. Please go ahead.
Just one question from my side is on the fixed orders currently. So how much of the current order book is fixed price and how much is linked to variable?
I don't have the breakup right now of fixed this. But typically, if you look at some of our international orders, would be most of the international orders would be fixed. But I'll say that generally all of them are hedged now, so I don't see any significant risk. Civil and railways generally have a price variation clauses. India T&D depends upon the type of client and the type of project. Vivek, I honestly, it will be difficult for me to guess a number. Maybe we'll give a number to you separately, work it out.
Sure. Thank you.
Thanks, Pasha.
Thank you. The next question is from the line of Hiten Boreja from Joindre Capital. Please go ahead.
Hello. Good morning, sir. So most of my question has been answered. I have only one question. So what would be a tax rate for this year and next year?
Tax rate for the next year should be normal at about 25%.
For FY24 and for FY23?
FY23, we have already, for 9 months period, on a standalone numbers, it is working out at about 26%. On a console, since there is a, deferred tax asset that has been created because of the losses in SA Brazil. So overall tax rate is coming down to about 15% or so.
15% in FY23. And sir, you told 25% in next year. That is on console level or on standalone level? So I wanted a number on console level, right? Okay, sir. So 15% in this year and 25% next year, right?
That's
yeah. Okay. Thank you.
Thank you. As that was the last question for today, I would now like to hand the conference over to Mr. Vimal Kejriwal for closing comments. Over to you, sir.
I'll just say thank you very much for your continued interest in KEC. Thank you.
Thank you, sir. Ladies and gentlemen, on behalf of KEC International, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.